Hello, everybody, and welcome. I'm Mike Coe, and this is Open Interest. What interests you? Let us know in the comments section below. Buy low, sell high, the oldest adage in the markets, possibly one of the most useless as well. But certainly it would be reasonable to ask why, if one likes a stock, one wouldn't prefer to buy that stock at a discount. Everyone wants to get a better deal. If you liked stocks generally, and let's use a broad market proxy for them, such as the S&P 500 or the Dow Jones Industrial Average. So if you liked owning the Dow Jones Industrials at nearly 36,800, which is where it peaked in January, why wouldn't you want to buy that same basket of stocks now that they are effectively on sale at 33,240? That's nearly 10% off. Of course, the fundamentals against stocks is pretty straightforward and has been discussed broadly. High inflation, rising rates, geopolitical risks, slowing economy. Knowing these things is only moderately helpful in the near term. As I speak to you now, I'm sitting in Northern California, a place known to be at risk for earthquakes. We know why earthquakes take place, and seismologists have the devil's own job trying to predict when the next one, or more importantly, when the next big one is going to take place. But still, we turn to them to give us color when the earth starts shaking underneath our feet. Where is it shaking? And is this the type of shaking that's normal? When the financial markets start shaking, I want the guy looking at the seismometer, the technical analyst. So let's hear what my favorite chartist, chart master Carter Braxton Worth, had to say earlier today on CNBC as the day's events unfolded.
First of all, what gives with the action from Friday's terrible sell-off to yesterday's complete turnaround, and now today a resumption of what looks like a pretty broad-based decline?
Right. In a way, it's the volatility that's the issue. And it's also every third day we get that rebound, which is to say hope is still alive. And there's nothing wrong with that, but it means you never really get the cathartic sell-off. You never get the capitulatory type conclusion. And so let's take the small caps. I mean, Russell 2000 has been in and out of a bear market, however you want to define that, 20%. It's not about that. It's that equities have been topping for quite some time. And we also have, and I think this is important, a bifurcated market. And the history of bifurcated markets is not good. So think about this. We have extreme strength in certain stocks, certain areas of the market. Think about how strong energy has been, materials, steel, aluminum, precious metals, consumer staples, utilities, all up and to the right. And the exact same time, we've had extreme weakness in biotech, just gets worse, and technology and semis and retailers. And so when you have a spread like that, there is the thought that the strong stocks have it right, that energy is leading the way, and that the material stocks are right, and the weak ones will start to bottom. But bifurcation actually ends the opposite way. The strong start to crack. We're seeing that now. Metals and mining are cracking. Energy is cracking. A lot of the steep run-up in certain staples is starting to give way, and the weak get worse. And so we're starting to see that kind of unfolding. I think there's more downside, there's more stress ahead, and it's just a time to postpone most all new buying.
Okay, so earlier today on Fast Money, I highlighted a trade that I saw in the SPX options. SPX options, obviously the options on the SPX index. These are cash settled options. They're European options. In this way, they differ somewhat from the ETF options that we talk about more frequently. But the trade that I saw was what we call a collar. It was a big purchase of the July 39.50 puts, 9,375 of those traded for just over $100 a contract, and then a sale of a like amount of the July 45.50 calls. Net, the trader laid out about $52 a contract times $100 multiplier times over 9,300 contracts. That worked out to an outlay of about $48 million in premium, and that was against what looked like a combo. So they probably traded it initially delta neutral, but that's a hedge against about a $3.75 billion portfolio. When that trade took place, the S&P was trading a little over 4250. Obviously, it closed well below 4200. So even that trade couldn't have been put on at the same price by the day's end. But I figured what we would do is go over a couple different ways that people can hedge their portfolios and what the pluses and minuses of those approaches might be. So with that, we have a couple of charts here. And let's take a look at the first one. The most obvious way that one can hedge a portfolio is by buying a put. So in this case, I'm looking at July put. And here's the problem with implementing a strategy like that at this point. The challenge that you have is twofold. One, the market has already declined pretty significantly. So where that protection is going to kick in is still going to be a decent discount to where we are now. So a lot of damage will occur to your portfolio already. But there's another problem, and that is that as the markets become more volatile, options premiums will rise. We often refer to that as implied volatility. Now, that is one of the reasons that you might see traders do what that institutional trader did, which is in our next chart, where you would sell an upside call to help finance the purchase of that downside put. Okay, so this helps the issue with the increase in options premium. But there is a couple sort of trade-offs that we have to contend with. The first is that by selling the upside call, you are limiting your potential upside gains. So if you sell a call at a strike that is below your cost basis, it is possible that you could even be locking in losses. Now, chances are with a 10% decline, if you've been a long-time market participant, that's not necessarily going to be the risk. But also take a look at the example that I provided here. The upside call that I'm selling is the same distance from the current SPY price as the put that I am purchasing. And yet, it's not offsetting the cost. So essentially, I'm going to lay out money. And if the S&P just stays right here, I'm going to end up paying that premium and not getting any real protection. I will have sacrificed some potential upside gains, and I'll only have protection if the S&P falls significantly from here. But it's going to, again, still come at a cost. And why is that? It's because when the market becomes more volatile, as it has, it is not only that options premiums might rise. Sometimes you will see the price for put options rise more than the price for call options. So essentially, we call that skew, the increased price of the downside puts relative to those upside calls. So in cases like this, it might make sense to try to mitigate the cost of your insurance still further. And in our next chart, we actually do that. And in this case, what we're doing now is selling a further out of the money put. So purchasing an out of the money, just out of the money put, selling a further out of the money put to reduce the cost, and selling an upside call. In this case, I chose strikes that essentially made the net outlay essentially zero in terms of options premium. Now you have a buffer zone, essentially the distance between the long strike that you own and the short strike that you're short. You still have some upside market participation. Of course, it is capped because you're short that upside call. But at least if the market just sort of lingers in here, you're not also going to be laying out premium. Is this a perfect way to hedge? No, it isn't. And it's not a perfect situation either, because we've seen a big increase in volatility and the markets have sold off fairly significantly. That said, if you happen to believe, as Carter does, that there could still be additional damage, and there are other market participants that would seem to agree, this is a position that you can take on some or even a portion of your portfolio that can mitigate at least a portion of the downside risk. I hope that helps you understand the different approaches that one can take to hedging a portfolio just a little bit. I'm Mike Coe. Thank you for watching Open Interest. If you like this kind of content, please hit the like button, hit the subscribe button, and hit that notification bell to be alerted when we produce new videos.
If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/Open Interest. And of course, you can also follow or tweet me at Michael_Coe, or go to our website, www.openinterest.pro. Thanks for watching.